Good evening, everybody. Welcome. My name is Shirley, and I will be your moderator tonight. I am so excited to welcome Mark DeBroux as our speaker this evening. Mark DeBroux is a seasoned accounting and consulting professional specializing in healthcare accounting, tax planning, revenue cycle management, mergers and acquisitions, guidance, and he holds a bachelor's in business administration, majoring in accounting and finance, and is a licensed certified public accountant in Wisconsin. Before we get started, I do have a couple of things I want to mention, some housekeeping things. The first is that CE is not available for this webinar, and we are recording the webinar this evening, and we'll be sending it out over the coming week. And lastly, we'd love to invite you to please enter your questions at the bottom of your screen in the Q&A box. We will get them, we will hold them and get to them at the end of the presentation. Mark, welcome, and thank you for being with us tonight. I'll pass it over to you now.
Thanks, Shirley. Appreciate it. Hope everyone's doing well tonight, and thanks for taking the time. Appreciate Henry Schein inviting me for the presentation. So as stated, the topic is 2023 year-end tax guide, overlook deductions and strategies. The objectives that were outlined, we have as, I'll get the slide to flip. We have critical tax deductions that are commonly missed, tax code updates, including pass-through entity tax and employee retention tax credits, which we'll touch on a little bit. That's a really hot topic or a debatable topic. Section 179, depreciation, deduction options, and strategic year-end equipment purchases, potential, and other write-offs. Let's discuss a little bit about cost segregations and how this could affect your tax return and be one of your largest deductions if you're a business owner in the healthcare space. Personal tax implications of funding HSAs, health savings accounts, retirement accounts, Roth IRAs, and 529 plans or educational plans. And then some cash flow considerations and strategies and planning tips for 2024 we'll touch on lightly. So critical tax deductions commonly missed that we see. And it's more important than ever to look for tax deductions related to both your business and deductions related to your personal tax return. For your business, you always want to look for deductions that what the IRS calls are ordinary and necessary costs incurred to operate your business. And if you want to get real geeky, you can go look for the IRS publication 535, which outlines what business expenses are realistically. For your personal tax return, you need to look to determine if you can itemize, potentially using some of the strategies that exist out there, because there's been some major changes we'll get into in a moment. And the other option, which a lot of people are defaulting to now, is the standard deduction amount. Then we look at maximizing retirement savings, which is one of the bigger items in a tax deduction that you can take advantage of. And then maximizing deductions for medical costs. The use of health savings accounts are always something that we get to year end and we get into the tax preparation season, and we find that we have some issues of what people have funded, haven't funded, how they've used those dollars, and then potential tax advantages that exist for college savings. So the big thing when it comes to your personal taxes, and the biggest item is can I itemize or take the standard deduction? So I have outlined what the standard deductions are for a married filing joint individual, a head of household individual, and single individuals, and the dollar amounts are there. So those are what we call the thresholds. And then if you're over the age of 65 or you're blind, you get an additional $1,850 added to the standard deduction. So we'll get into it a little bit when I call those threshold numbers, but those are the numbers the government's giving you on the front side as right from the beginning, a deduction to take against your income. So in 2017, the Tax Changes Job Act changed what itemized deductions, what we historically have taken. They capped our state and local taxes at $10,000. So state and local taxes make up your property taxes, anything based on value on a tax, whether it's vehicle registrations. It capped real estate and withholding taxes that you have on your paychecks and what you pay to states and other states for state tax deduction. So many of you being physicians can be high income earners, depending on the state that you live in. If you're living in a higher income state, this deduction severely limited what you can offset your taxes with. So that's really been a painful item, and we'll get into a topic that might help some of you, depending on your structure of your entity. So job-related expenses that you used to take on your personal tax return were suspended, and other miscellaneous deductions you used to take on your tax return. Some people say I did job search expenses, were the big ones that we saw, tax preparation expenses, my investment expenses for, paying my investment advisor, the fees that I used to deduct for my investment advisor for taking care of my assets, which can be tens and tens of thousands of dollars. They used to have a threshold that you had to get over based on your income, but they were deductible. That's also now gone under the Tax Changes in Job Act. Under the home equity loan interest, it used to be if you used it for something related to your home, or you could use it for other purposes. A lot of times you can get deduction on that home equity loan interest. There's no longer a deductibility for a lot of home equity line of credits unless you use it to improve your main home or your second home. So that throws what a lot of people used to using their line of credit for and taking the deduction for it. Now a lot more questions are asked as to how that line of credit is being utilized. The result is it's harder to itemize or take larger deductions over that standard deduction. So when it comes into planning for deductions, the only ones you can really try to plan for are charity and state taxes. And that state taxes is dependent if you have income that's coming from a pass-through entity. Pass-through entities, we can get into a little later, but they're partnerships. They are S corporations that have income that comes through to you on a K-1 form. So you may be employed by your practice, you receive your W-2, and in addition to your W-2, you receive a K-1 for the residual income passing through to you. And a lot of times that takes some specific planning to determine what income should be on that K-1 versus your W-2. There's some IRS requirements being paid for your professional services. So when it comes to donations, we talk to clients and we always say, okay, we have a threshold that we need to get over. And to get over that threshold, I know you have $10,000 in taxes that you paid almost automatically if you have a W-2 sitting in front of you. So now if you're married filing joint, I need $27,700 to get over, to itemize. So my first $10,000 comes off. So that means I have $17,700 that I need to be able to itemize before I'm past the free dollar deduction the government's giving me. So if I have home mortgage interest, I'm paying on a home mortgage. I mean, that can be a substantial amount of money. So if people are holding a mortgage and we can deduct the first $750,000 of mortgage debt, if we have that loan sitting at 3%, well, that can give me $20,000 plus in interest. So that helps me get closer to being over that threshold or puts me over that threshold. But if your home is paid off or you don't have that large of debt on your home, sometimes we can't get over the threshold. So then we come to itemized deductions. Well, you have to give a lot of money to charity in some circumstances. Because if your home is paid off, I got $10,000 in state tax deductions. I got to get $17,700 to charity before I can start deducting anything. So sometimes we talk to clients about how charitable their intentions are, and we talk about grouping their charitable donations. Kind of like years ago, we used to group real estate taxes. We used to pay them every other year potentially. Same thing with charitable donation. We talk about putting a double donation into your charitable organizations you want to give to. And so you may give double in 2023 and skip 2024 entirely to try to get better bang for the buck. Another option is you can donate appreciated assets, and that helps on that same threshold, but you could also set up a donor advised fund. And that donor advised fund, it's normally held by, it could be your local community foundation, it could be Fidelity, Vanguard, Schwab. They all have these donor advised funds. They all have different rules as to how the funds work internally and the mechanisms, but the basics of them are is you put a lump sum of money into that donor advised fund. It's instantaneously a tax deduction at the time of the donation, and that's taken on your tax return. So let's say you decided to put $50,000 into it of appreciated stock. So you don't pay taxes on the stock that you're putting in because the IRS allows you to give an appreciated asset and not recognize a gain on the transition. and then I get a deduction for what the value of that stock or whether I put cash in as part of my itemized deduction. So I have a lot of clients that use donor advised funds, get that upfront donation, and then as the years go on, they give the money to charity through their donor advised funds. So if they want to give money to their church, their YMCA, their Boys and Girls Club, whatever charity is near and dear to their heart, they notify the custodian of those funds, and the custodian of the funds sends the money to those organizations, which then depletes the donor advised fund over time, and you can replenish it. So that's a big planning area that we spend quite a bit of time with clients discussing. The other side is taking RMDs, required minimum distribution. So if you're of the age to take an RMD, and these have been changing, a lot of us are used to hearing it's 70 and a half. I have to take money on my retirement account, my IRA. Well, now those dates are changing. And you can see on the slides, if you're born between certain date ranges, it's changing. The individuals that are born after 1960, the age of 75 is going to be when they have to start the required minimum distribution. If they give required minimum distributions or have them, they can give up to $100,000 a year out of their IRA as part of their required minimum distribution to a charity and not pay taxes on it. It doesn't get the tax return at all. So it's a great way to move wealth potentially and give money to charity at the same time. So the other item is state taxes. And when the Jobs Act went into place and put that $10,000 cap in, states try to get creative in finding ways to get deduction. So a lot of states were trying to make it say, okay, paying state taxes is charity, or paying state taxes creates a deduction on another means. And some states got ahead of the curve and they allowed the entity to pay the individual's taxes. And now this mainly applies to pass-through entities, partnerships, S corps for the most part, and 30 states now have adopted regulations to allow the entity to pay the state tax liability, which then the owner does not need to pay that on the personal tax return. The business got a business deduction, and then you don't have to worry about the $10,000 cap. So there's some mathematics that have to happen to determine, is it worthwhile paying at your business tax rate? Like in the state of Wisconsin, corporations are taxed at 7.9%. Their top individual rates are roughly 7%. So we're paying 0.9% more, but we get a deduction against federal income that we don't get on the personal return. So we look for individuals that this does work for. It doesn't work for everybody. Depends on your income. Depends on the pass-through income. But that is something that's out there, and all 30 states have different rules. Example, I work with clients in Michigan. Michigan, once you opt into doing pass-through entity, you're locked in for 3 years that you have to do it. State of Wisconsin, it's a year-by-year election. So every state has a different angle on this. And the IRS did approve this finally about 2 years ago and put their blessing on it. So that was a positive that we definitely had. So it's really taking into account and making sure that the mathematics work and that you have an entity that allows this to happen. Again, partnerships and S corps. So another deduction that exists, again, partnerships, S corps that are out there for an individual that's operating through a Schedule C, meaning their business is reported on the personal tax return as part of the personal tax return filing. They may qualify for what's called qualified business income deduction, or QBI. QBI is a deduction of roughly 20% of the income that comes from that business onto your personal tax return. The problem we have in healthcare, it's one of the learned professions. So accountants, attorneys, I'll say engineers, architects, I think are excluded in this law, but the learned professions, they said, no, you're treated as what's called an SSTB. And you may not be able to get a deduction for that 20% of the flow through income. This is the non-W-2 income of your practice. And so you have to be below thresholds as a healthcare provider. So $364,000 is a threshold for a married couple. $182,000 is for a single filer. But you have to look at, do I have other businesses that I'm part of, that I'm an owner of, and I have pass-through income coming through to me, and that I can have 20% of that income be subtracted from my taxable income. So if you've got an investment, let's say you've got friends that you've invested in another business with, or family members you invest in our business with, you aren't subject to the limitation of the income caps. You could have 20% of those profits, excluded from federal taxation. That's a big deal for a lot of clients that have been flow through income, that you can reduce 20% of the income from taxation. So it's a above the line deduction, as we used to refer to it. Well, we get back to that discussion of what are my business expenses, and an IRS states they need to be ordinary and necessary costs to be deducted on your business tax return. So if you're an owner/employee, because if you own the practice that you're part of and you're an employee of your business, you're both the owner and an employee, you can deduct expenses. Whereas an employed physician, someone who's employed by somebody else, is not an owner, a hospital system, or an associate that's working for a group that is not in the ownership of the group, they may not be able to deduct a lot of the expenses because the Schedule A itemized deductions eliminated that ability. And it depends if the business wants to reimburse the individual. But if I'm an owner, what deductions can I run through my business? And so a lot of times things that we see overlooked are how medical premiums are handled, and whether those are Medicare premiums for an older individual that is still working, whether it's disability premiums, that the discussion with your tax advisor, whether you want to deduct those or you want those to be a post-tax item. So if you ever collect on the disability, that you don't have to pay taxes on the disability income. Long-term care insurance, a lot of times is missed. People don't submit to long-term care premiums as being a deduction, which is fully allowable. So those are things that we a lot of times see not deducted through the business that can be. Other items are automobile expenses. A lot of people say, okay, I'm gonna take mileage, or I'm gonna take a deduction for depreciation. That's a discussion with your tax advisor, what's best. There is some downside to owning a vehicle and deducting it through the business. Used to be everyone got really, really excited about deducting the entire cost of their vehicle that was over 6,000 pounds. That's kind of gone away as a great tax deduction, because now when you trade that vehicle in, you have to recognize a taxable event. You can no longer exchange that tax-free. So people do miss, the parking costs, the tolls that they incur. You can take that over and above the mileage. So that's the items that we've seen missed. And then also meals. We had a lot of changes. The tax changes in Job Act eliminated meals and entertainment from deductibility. So with the pandemic, they put back in the law that 100% of meals for the years 21 and 22 were deductible as long as they were from a restaurant. And in 23, we're back to 50% deductibility. So we hope to keep that 50% deductibility, but we still lost entertainment. So if you take someone to a sporting event, you can't deduct the tickets. Same thing with a concert. They're no longer business deductions. So those are items that we see frequently happen. Other items that we see missed for an individual who owns their own business is deducting of their personal umbrella liability that they have covering their personal assets. A lot of times it'll fit in that you can deduct those expenses. Home office expenses. So if you're working from home and you fit the right criteria against a discussion with your accountant, you could take some home office deductions. You got storage unit rental fees that you're paying for because you're keeping business property in that. Those can be deductible. Technology, when it comes to smartphones, laptops, iPads, tablets, you want to look at those and make sure that you're deducting those. Some of those are subject to limitations as what personal and business use says. So it's a discussion with your tax advisor, but definitely there's deductibility for it. Same thing when it comes to internet and cell phone plans. That becomes so commonplace now. You need to determine what's really business, what's personal. I haven't had an IRS argument, wholly on it unless someone was deducting their entire family plan through the business. That was the problems were. And then it's, are the rents that you're paying, are you paying yourself fair market value rents for the property that you own and are leasing to your business? So that is something else to look at. When it comes to tax code changes, we're all waiting to see what happens to the debt ceiling bill that's hanging out there. They had the discussion back in June. They kicked the can down the road to October. Now we're under a 45 or end of September. Now they kicked it down 45 days. So middle of November, we're going to be looking to see what they're going to do with the tax law changes. But things that are front and center with the government right now are tax that Jobs Act that was passed, a lot of the provisions only last until 2025 when they expire. Tax rates will go back to the 2017 levels. The standard deductions that we talked about before are cut in half. The personal exemptions that we're used to having and the child tax credits that we've been getting the last several years also changed. The qualified business income, they call it the QBI, that 20%, that goes away. The $10,000 cap on state and local taxes also goes away. And then this estate tax exemption is going to be reduced dramatically. So we'll get into that a little bit later too. So a lot of these provisions that the government put in are expiring in a couple of years. So if they're looking for revenue generation, they may let these all just happen, or they may be looking to extend a lot of these. And that's been some of the discussions that have been taking place for the last several months. So we're waiting to see where that really goes. So the big item when you own a business is buying assets. And as you're buying assets, you want to make sure you're buying assets that you can deduct, and what options do I have for deduction? So the first pass that we've had, and it's been a great opportunity for the last several years, is that since 2017, we've been able to take bonus depreciation. And in bonus depreciation, as it outlines on the slide, from September 27th of 2017 to December 31st of 2022, we could deduct 100% of the cost of the asset for the federal tax purposes. And we didn't have to worry about using Section 179 as much. We can deduct 100% of those assets. Where the 179 planning, which we'll get into, comes into play is that every state has different rules regarding how they handle bonus depreciation. A lot of states follow federal, other states depart. And so like in the state of Wisconsin, we have a departure from federal law on bonus depreciation. So we do not get to deduct 100% of that asset under bonus. We need to look at it as Section 179. That bonus depreciation is decreasing by 20 basis points each year. From 2022 through 2027, when it'll expire entirely. So bonus depreciation will no longer be in the vocabulary if the tax law continues to play out as it has been. So then we go back to Section 179. And in that Section 179 world, that's where a lot of us have gotten used to having deductibility for our assets we're buying, whether it's exam tables, whether it's, you're an ophthalmologist, it's lasers, whether it's surgical tables if you got an ASC. So all the assets that you could be purchasing are eligible for upfront depreciation. And most states follow the federal on Section 179. Vehicles also fall into this, but so there's a caution. You want to talk to your tax advisor about it. But you're allowed to take Section 179 depreciation on all assets as long as you have only bought $2,890,000 of the assets. So it's a pretty high number to get to. And then the deduction on Section 179 assets is limited to $1,160,000. So for a lot of the clients I work with, these are pretty large thresholds to get over, and our annual purchases aren't that high. Some are, but normally Section 179 fits well. So it's a debate of whether we use bonus or Section 179. And then we use that for year-end planning purposes. We want to get income down and we need some new assets. Now is the time, if not already almost a little bit too late, to be talking to your vendors to say, what assets are out there that I need to replace and can I get in service by the end of the year? Ordering it doesn't count. It has to be physically in operation, in use on December 31st for you to take a deduction. Another thing to look at is your capitalization policy. This is a lot of times overlooked with clients. The IRS gives you a kind of a free pass, and they state that you can have a policy in place that allows you to deduct the purchases of what they normally would call a capitalized asset, something you need to depreciate over time, that you can set that policy at $500 or elect to put it up to $2,500. It's simply a document that you keep within the corporate records. Nothing your attorney needs to draft. Your accountant should have an outline of what that should state, but it's putting a capitalization policy in place, and it's for every unit. So if I buy a computer and the computer counts as a laptop, I get a keyboard, I get a mouse. Well, someone tells me that the entire computer costs them $700. But if I break out the cost of the actual laptop versus the keyboard versus the mouse, so the components that go with it, I may be below that $500 threshold, and I can just expense the asset. So that's a possibility that you can break an asset apart into different components, and a computer with a good little example. But the next big one is cost segregation studies. This is if you own a building or acquired a building, and it doesn't have to be your medical office. If you bought an apartment building, you bought a commercial property, it allows you to take that real property, real estate, and break it into different components and accelerate the depreciation in earlier years. For commercial property, IRS defaults to 39 years. If you buy a building, it is going to take you 39 years to depreciate that building fully. But if you engage a cost segregation specialist, and it has to be someone who specializes in it, there's documentation that's needed, some is engineering studies and such, you can break that building into shorter depreciable lives, 5, 7, 15 years. And a lot of times when we look at these, we can move 20, 30% of the building's original cost into these shorter lives. So it accelerates the depreciation deduction that we can take on it. So it doesn't add more depreciation. Over the 39 years, the depreciation is the same, but I can front load the depreciation and take it against current income, which a lot of times is a big tax advantage today because I don't have to wait forever. So it's a time value of money calculation. So it could be one of the largest deductions that you've ever taken in your lifetime of your business. Now kind of back on some of the personal stuff, health savings accounts, retirements, Roth IRAs, health savings accounts as a self-employed or as an individual with a high qualified, high deductible health plan, check with your insurance that it is. You can take a deduction personally for a self-only plan of $3,850, or a family plan at $7,750. You're allowed to catch them all if you're over the age of 55 or older of $1,000. That's for you and your spouse if over 55. And you have until the following year, April 15th, to make that contribution if you're short on that dollar amount. That's what we try to work with clients to make sure we're maximizing those dollar amounts in those plans. When it comes to IRAs, a lot of professionals I work with, we have a hard time doing deductible IRAs. We usually have really good qualified plans within the company, 401ks, and our income thresholds don't allow us to do a deductible retirement plan contribution because the income phases out with the numbers on the screen. So it also interplays if you're an active participant in a retirement plan. A lot of times you're excluded just from being an active participant. The 2023 contribution is $6,500 for an IRA. The catch-up contribution for somebody 50 and older is another $1,000, so it's $7,550. You have until April 15th of the year after the tax year to get your contribution in. But a lot of clients that we work with, we look at doing Roth conversions. And so for those clients that can't put money into the IRA because of the phase outs, they can put money to an IRA as a non-deductible contribution. And the IRS currently allows you to then do a conversion to a Roth IRA. So it's called the backdoor Roth, and it allows you a lot of ability to put additional dollars away in that Roth methodology. So if you've got money that you had from a previous employer that you've rolled into a Roth, into a regular IRA already, you may want to discuss with the plan administrator, as well as your accountant, potentially tucking those dollars up underneath the company plan. And then you don't have any money in IRAs, and you can use this Roth conversion component. Another item you may have heard of is cash balance plans. A lot of practices have those. It's a supercharged way to fund your retirement. It's based on actuarial calculations. Will allow you to accelerate several millions of dollars into an IRA or to a retirement plan that the company can sponsor. So several clients look at those and utilize those over and above their 401k plans. Continuing that, we get into 529 plans. That's college savings plans. Every state has a plan. You have to follow the state rules. There's usually a deduction for the state only. So if you put money into them, there's usually rules and limits and dollar amounts depending on your state. And if you're a resident of that state, you can get a tax deduction. The funds grow tax-free. You withdraw it for qualified education expenses, which there's a whole list of them. And if they're utilized, you don't pay any taxation on any of the earnings. The key is matching up when you paid the expenses to when you withdraw the money. The IRS has gotten very picky, I'd say, that if you are a person who pays for 4 years of college, and then at the end of year 4, you decide to reimburse yourself for the preceding 3 years in addition to that 4th year, the IRS is going to say that only the 4th year expenses qualify and the first 3 years are a taxable event. Other opportunities that you have out there is the American Opportunity Credit and Lifetime Learning Credits for college tuition. A lot of the higher income individuals that I work with that are physicians, we usually phase out of these so we don't even have a conversation with the client. The key is, can we potentially have your children who are, if they're working and making money, are they able to take advantage of some of those credits and get better tax bang for the buck tax-wise than what you can? Also, it's funding Roth IRAs for your children if they're working. So if they can work in your practice, they can perform a job function within the practice. You can have them funding a Roth IRA. And it's a good item also because Roth IRAs, you can use part of the Roth to also pay for college expenses. So it's not a bad idea to put money into a Roth. You can utilize your Roth or your child's Roth to pay for part of their education expenses. When it comes to things to do for year end, you want to maximize your 401k. So this year, the 401k deferral is $22,500. If you're over age 50, you can put an additional $7,500 in, and that's money from your paycheck. So we're talking $30,000 is the current 401k amount. And that dollar amount changes every single year. It's been accelerating rapidly the last couple of years, part of it due to inflation. But there's a lot of dollars that can be moved into a tax-free environment. The key is splitting it between Roth and pre-tax dollars. New rules going in place that have now been delayed is that your catch-up contribution needs to be automatically put into a Roth. So that $7,500 need to go into a Roth. You don't have a choice to make that pre-tax, but that's now been delayed for 2 years. So that was supposed to be effective this year, but it's been kicked down the road. Funding your HSA to the maximum is a key. We talked about those dollars. That your spouse can also do a separate health savings account if she's over the age of 55 and older, that they can fund $1,000. And you have until April the following year to finish the funding or get money out if you've overfunded. Another thing to consider is, have you worked on your estate? Estate planning has never really been a problem for most of the clients I work with, because right now a person is exemption of $12.92 million. And in 2025, it reversed to being half of that amount. And there's discussion in Congress going even less than that. So if you've got a large estate right now, you don't have a consideration on the problem, but that may change rapidly in 2025. So if you do have an estate that's in anywhere $3 to $6, $8 million, you may want to discuss of trying to lessen your estate tax burden. So a lot of times we get into annual giving. So right now, annual giving, $17,000 per person. You don't have to do the IRS reporting. So if I want to give money to my daughter and my son-in-law, I can give each one $17,000. So I can give a total of $34,000, and my wife can do the same thing. So I can move $68,000 to them if I wanted to, without having to do any reporting to the IRS for gifting. So the employee retention credit, I don't want to get into this real deep. It's a really heavily debated item right now. The IRS actually paused the program as of September 14th. They're not accepting, or they're accepting, but they're not processing any ERC applications. But ERC was set up during the pandemic to help employers receive tax credits for keeping an individual employed. This is over and above the PPP loans that were out there. And so there's a lot of money involved in this. Most of you who own business, I'm sure, have been contacted by third parties saying, hey, you qualify for hundreds of thousands, if not millions of dollars of credits for your employees, because you can get $7,000 per employee per quarter, so $21,000 per employee, or let's say more than that. $7,000 per quarter, that's $28,000 per employee. So the dollars add up in a hurry. And a lot of the IRS has caught on to a lot of fraudulent schemes that are out there. This is an entirely separate webinar to get into. But if your business has not looked into ERC credits, talk to your accountant, look into the possibility. A lot of the clients that I work with, we didn't have the ability to go for ERC credits because we didn't have a true governmental shutdown in the state of Wisconsin. People try to interpret it that way, but we didn't have it. But our surrounding states, Michigan, Illinois, Minnesota, they all had a governmental shutdown of their healthcare. So it depends where you're located also as well that works for you. So that's where we come to questions and answers. I'll take your questions now, so I want to try to leave 30 minutes for that. So do we have any questions out there, Shirley?
Oops, sorry, there we go. Thank you so much, Mark. And let us just want to invite everybody now. We do have one. Yes, the question is, will this be emailed to all of us? In case I forgot what was talked about. Also, is Mark available to hire for CPA needs? I am located in Florida. Before you answer that, Mark, I will tell you that this presentation has been recorded and will be emailed out to all attendees and all who registered over the coming week. But Mark, do you want to address being available for CPA needs? And the person is located in Florida.
I have clients throughout the entire country that I work with. I'm more than happy to talk to any individual who wants. I work with CliftonLarsonAllen. We are a CPA firm that we have a presence across the entire country, and we actually have healthcare specialists that are located in Florida. So I could connect you with someone in Florida also who does similar work to what I do. So,
and Mark, if we could put your contact info, that would be great as well. If you send that to me, I can add it to the chat.
Sure, I'll get it to you.
And while we get that and post that, if anybody has questions, we keep inviting you to please post them in our Q&A box at the bottom of your screen. While we wait for those, Mark, what commonly asked questions do you get that you can share in the meantime?
Usually the biggest question I get from clients are, what can we take for deductions? Can I get my asset put in place? Where are my tax brackets going to be at? So we do a lot of tax planning. So right now we're working through the extended tax deadline, which is Monday. So we have a lot of returns that seem to be needing to be filed yet because clients got invested in investments that don't kick out their information until the middle of September. So right now we're gonna launch right into year-end tax planning with a lot of individuals and making sure that they're filling up tax brackets. We're allocating money properly on a W-2 versus if they're a flow-through entity. So a lot of clients they try to operate in the S corp world, and then in that S corp world, we're trying to make sure that we pay individuals appropriately for their salaries that they're or the income that they're generating. So if they've got ancillary sources of income from X-rays, ultrasounds, what we call covered services, where we have nurse practitioners, we have employed physicians, that income we try to pass through so we take advantage of some of these other flow-throughs that we talked about in the presentation. So a lot of questions on what's the right amount of income to put on my W-2. A lot of questions of making sure that they're filling those tax brackets appropriately. A lot of questions on health insurance and how to handle it and the costs and how to handle the deductions for the employees. So we do a lot of work in that arena as to what makes sense for the business to pay for and what makes sense for the employee to pay for from a tax standpoint. So it's a wide realm of questions that we get. A lot of them that really start ramping up their questions are towards the end of their practice career, trying to figure out if they have enough assets to retire. And then when they retire, what is the best way to utilize their money? So we do a lot of planning with our retirees that have a significant amount of money in their retirement savings because they funded that through their practices. It's their largest asset for most of them. And a lot of them, we do a lot of Roth IRA conversion planning, taking chunks of it to fill up tax brackets, the 22, 24% tax brackets. So that money can then generate, grow tax-free. Hopefully it's, as we call it, the last money they use in their lifetime. Another conversation I have frequently with clients is on health savings accounts. I say normally you have financial means that you're able to put money into the health savings account, fully fund it, and try not to withdraw money from it to pay the medical expenses, because normally they're making having enough income that they can pay their medical expenses outside of using the HSA. The HSA grows tax-free. They can then use it at a later date, go into retirement, treat it somewhat like an IRA even. And so that's one of the biggest discussions I have with a lot of clients is letting those HSA accounts grow and not withdraw the money from them every single year just because the dollars are there. Because a lot of those HSAs are hooked up with a bank through an investment company that you can go then and invest the money through, whoever the investment company the bank is aligned with, and put the money into, mutual funds, individual stocks, depending, so you can have tremendous growth within your health savings account. So a lot of discussions around not utilizing those funds So it's a lot of the small things that just kind of get lost that we have a lot of discussions on. A lot of discussions on leasing versus buying cars and the advantages of leasing versus buying. I'm a big proponent of leasing cars and setting up those leases to allow you to have the business write off some of the value of the car and take a tax deduction from the business standpoint. We add back the personal usage to your W-2, which there's some IRS mathematical calculations. Some of those calculations have not changed since 1986 is some of the values that we need to add back on. So I like leasing of the cars, especially if the individual wants to convert that car to a personal family car at the end of the lease. And we can usually get some pretty good tax strategies around those car leases. Other things that come up frequently. Oh, go ahead.
Oh, no, sorry, I interrupted you. Go ahead.
So a lot of questions that come up with individuals are if they're investors in ancillary sources of revenue from the medical side of things. So it's the ambulatory surgery centers, if they've got some investments potentially in leasing companies that are leasing medical equipment back to practices. Their rental real estate is trying to maximize the deductions that we can take within those entities, as well as do we have the ability to have that income in a different format to help offset income from other sources that you may have invested in. So it comes down to, are you a passive and active in the activity? It's a whole set of rules regarding being a passive individual or being active. Some people like being passive because they have losses from other activities they want to offset. So we need to make sure we meet the IRS guidelines on passive versus active. Well, there's a whole realm of things that we work with the clients to make sure that they're putting themselves in the best tax position they can for the scenarios. The things that we really hate are when the client doesn't communicate with us during the year. Most of the relationships I have, I try to talk to the clients on a quarterly basis at minimum, and some prefer not to. Some just wait to the end of the year and in tax information. But a lot of clients I work with, I talk to them almost daily, weekly. But the thing that's really difficult is when you get their personal tax information and the personal tax return is worked through and you found you missed opportunities that could have been taken advantage of if you would have talked to the individual, whether that's the mistiming of the purchasing of assets, whether that is the missing of funding of their IRAs, 401ks, HSAs, and a lot of them, if they don't get us the information before that first deadline, we can't extend putting money into the HSAs and the IRAs past April 15th. So if you got me your tax information in August, and I saw you missed an opportunity, we've missed it. We can't get back to April. One of the biggest questions I get is just extend my tax return. I know I can't get it done by April 15th, and they think that that's an extension also of paying the tax. That's a myth. You have to pay your tax liability by April 15th to have a qualified extension. You may end up owing some money after that if the projection isn't on target as to what you owed at that point. And so you may end up paying penalties and interest, or potentially as far as an invalid extension could be claimed by the IRS if you owe a significant amount of money and you didn't pay that. So subject to larger penalties. So that's one of the biggest myths out there, quite honestly, is I can kick my tax liability down the road when that's not true. All the taxes technically are due to the IRS by April 15th, the year following. So we do a lot of withholding planning with clients. So we want to make sure that they're getting appropriate withholding in so that they're not penalized by the April 15th deadline, because a lot of people think that, well, I can pay all the taxes I owe on April 15th. Technically not. You need to pay it in at the time that you're earning the funds. The IRS considers income from a W-2 as ratable, and so the income is spread over the course of 12 months. The withholding is spread over the course of 12 months, so they break it into periods of the year for the calculation that's done. And if you don't meet the required withholding, which is 90% of your tax bill, or you don't have 110% of the previous year's tax paid in, you are subject to penalty from the IRS as well as the state that you live in if they have an income tax. So it's normally making sure that clients are in a protective position. If their income's down, we want to be at the 90% level. If the income's up, we want to be at the 110% level. And we try to do most of that planning through withholding on their W-2 from their paycheck. We get into paying quarterly estimates. If they're not paid ratably, 4 equal payments throughout the year, and we can't, what we call annualize the income, we can be subject to some substantial penalties. Because I've got returns I've seen going through here the last couple of weeks that we're looking at penalties in excess of $3,000-$4,000 because the client didn't communicate to us during the year. And to me, that's just money flushed down the toilet and handed to the government because you didn't have proper planning during the year. So most of my clients are pretty interactive on their planning, but there are some who don't know what their situation is entirely from an investment standpoint, large capital gains, so on and so forth, and they kind of get stuck because we don't have the communication. Others, they have their brokers talking to me, or whatever the case is, and we have a pretty good picture of what their income is at year end. So a lot of tax planning takes place. A lot of those questions we get are things that revolve around making sure they're protective, using up tax brackets, income is allocated into the right form of income, and making sure that they can pay the least amount of tax. There is no magic wand not to pay taxes, but there are ways to make sure that your taxes falling into the correct categories in the correct years potentially that can help minimize the tax effect versus compounding income on top of income and missing an opportunity in a certain tax year. So what are the biggest things we come across? I know it's a lot I just threw out there, but the key is interaction and interplay with your tax advisor is very important. And a lot of tax advisors are, I'd say, complacent when it comes to active tax planning. They send you your estimates or they tell you the withholding number to hit, and they don't plan on seeing you until the following tax season to do your tax return. I don't consider that a true service to the client. I think it's a disservice, and clients should be interacting with their accountant to make sure that they're getting the best bang for their buck. And usually we pay for ourselves with proper planning with the client. Any other questions?
It's so good to know. Yeah, we do. And that's really good to know. So thank you for all of those tips. Yeah, I think you answered this already, but you do take clients from California as well? Sounded like you said all over the United States.
I have clients from all over the country that I work with. And again, we also have people within the firm that I work with located in most states that I could refer you to a person that may be local to where you are. So either way, we could accommodate.
Excellent. Another question that came in is, what are approximate CPA charges for a single owner employee physician S Corp?
How clean are your records? Quite honestly,
Sounds like it depends.
It's a dependent question. I can have two clients that have very similar businesses. One of them engages us to do their monthly accounting compilation work, and their tax return costs are pretty minimal because we have a really good, what we call trial balance to work from. And to do the tax planning, we've had the conversation with the client throughout the year. We know what's going to be hitting that tax return. And the cost of that tax return is significantly less than what the client is who comes in at the end of the year. We have to do a bunch of adjusting journal entries. We found out that their accounting software, they didn't make the journal entries from the previous year to reconcile their books. The reconciliations maybe not on key, entries are wrong. And so the costs vary tremendously. I can have one client that, I'll just say I charge them $750,000, and then he'll talk to his best buddy. We'll say, well, geez, I had to pay $3,000. It's the amount of time and materials that we spend on what we're doing. So that's truly reflective of the quality of your books and records. And usually the client that's engaging us throughout the year, even though they're paying us more in fees, it's saving them in the long run, quite honestly. When I say they're paying us more in fees during the course of the year, they're not paying a big lump sum or a tax return and trying to straighten their books out. So there is not a standard fee schedule we work from. It's kind of depends how good your records are.
And that person is following up saying, absolutely clean, very new business. It's in its second year, minimal practice since it's new.
Single owner S Corp. If they're keeping basis records, they have if the proper elections are made in the year. Their debt structure is structured properly to allow basis. Those returns usually fall somewhere in the, I'll just throw a number out there, roughly $1,800. But I also got returns that are in the $5,000 range that they tell me the records are clean also. No, it really it comes down to how what your information in the format is. I mean, it's really hard to get someone a right on the spot
Right.
quote. We can give them a ballpark and say this is the range we're looking at, and because everyone tells me their records are perfectly clean, and we get in, and some are just absolute train wrecks and disasters, because
Right.
their previous accountant didn't really tell them what they had going on or didn't set them up properly, and know that's usually problematic. So starting out with a new client, usually it's a little more expensive getting that first year return done, but then we hit a rhythm because a lot of that setup work is done. And then it's kind of routine after that. Where things change is if you add a partner leaves, especially in S Corp and partnership situations, a lot of calculations have to take place on allocating income, a step up in basis, elections with the IRS. So all some things get really complicated in a hurry. For a simple, what do you think is a simple transaction to meet the government requirements becomes complicated.
Well, thank you so much. Those are all the questions that we have right now. If it's possible to get the best way for people to contact you, and we can. Oh, there we go.
What's the best way for me to get it to you? Should I just email it to you?
Okay, you know what? Yep, we can do that. Actually, anybody, we can do that. We can have it. We can connect offline, and then we will make sure to send that along to that information along to our attendees this evening. So that makes sense. Well, again, thank you so much, Mark. That was a really wonderful presentation tonight, and thank you all as well for joining us this evening. And as I mentioned before, we did record tonight's webinar, and we will be emailing it sometime over the coming week. We would appreciate your feedback via our survey that will pop up on your screen shortly. And thank you again for joining us tonight. We look forward to seeing you on future webinars.